In 2012, a stock that was once worth $62 per share finally bottomed out at $1.63. The company was Nokia. And millions of investors had watched it fall for over a decade, refusing to sell, convinced it would come back. It never did. Today I am going to explain the psychological trap that kept them holding, and how it might be costing you money right now. Welcome back to Daily Investor. This is a trap that catches almost everyone, from beginners to professionals. It is called the sunk cost trap, and it is one of the most dangerous mistakes in investing. The idea is simple but devastating. The more money you have already lost on an investment, the harder it becomes to let go. Your brain tells you that selling means admitting you were wrong, and that pain keeps you holding a losing position long after the evidence says you should move on. By the end of this video, you will understand exactly why this happens and how to protect yourself from it. In 1979, two psychologists named Daniel Kahneman and Amos Tversky published a groundbreaking paper called Prospect Theory. Their research proved something that investors had felt but never measured. The pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. If you find a $20 bill on the street, you feel good. But if you lose a $20 bill from your wallet, that negative feeling is about 2 times stronger than the joy of finding one. This is called loss aversion, and it is hardwired into the human brain. It evolved to keep our ancestors alive. Losing resources in the wild could mean death, so our brains developed an extreme sensitivity to losses. Now apply this to investing. You buy a stock at $50. It drops to $35. You are now sitting on a 30% loss. Rationally, the only question that matters is, what will this stock do from here? But your brain is not asking that question. Your brain is screaming, if I sell now, I lock in a $15 loss per share. That loss becomes real. And that feels unbearable. So you hold. You tell yourself it will come back. You tell yourself you have not lost anything until you sell. But that is a lie. The loss is already real whether you sell or not. Your portfolio is worth less today regardless of what you do with that position. In 1998, a finance professor at UC Berkeley named Terence Odean published one of the most important studies in behavioral finance. He analyzed nearly 10,000 brokerage accounts over a 6-year period from 1987 to 1993. What he found was stunning. Investors were 50% more likely to sell a winning stock than a losing one. Let that sink in. When people had a gain, they rushed to lock it in. When they had a loss, they held on and hoped for recovery. This is the exact opposite of what rational investing demands. Odean also found that the stocks investors sold, the winners they let go, went on to outperform the losers they kept by an average of 3.4% over the following year. In other words, investors were systematically selling their best stocks and keeping their worst ones. They were literally doing the opposite of what would make them money. This behavioral pattern has a name. It is called the disposition effect. And it has been confirmed in study after study, across dozens of countries and markets. Professional fund managers are slightly less prone to it than retail investors, but even they fall into the trap. Think about what this means for compounding. If you consistently sell winners early and hold losers hoping for a comeback, your portfolio gradually fills up with your worst performing stocks. Over 10 or 20 years, the compounding damage is enormous. Let me show you 3 real companies where the sunk cost trap destroyed wealth on a massive scale. First, Nokia. In the year 2000, Nokia was the undisputed king of mobile phones. They had 41% global market share. The stock peaked at $62.50 in June of 2000. Then Apple launched the iPhone in 2007, and Nokia's world changed forever. But millions of investors had bought Nokia during the glory years. As the stock fell from 60 to 40, they held. From 40 to 20, they held. From 20 to 10, they held. By July 2012, Nokia traded at $1.63 per share. That is a 97% decline from the peak. The investors who held the entire way down saw nearly their entire investment vanish. Second, General Electric. GE was once the most valuable company in America. The stock peaked near $60 in August 2000. Over the next 18 years, it fell relentlessly. By December 2018, it hit $6.40 per share. An 89% decline. GE was in the Dow Jones Industrial Average. It was considered the safest of safe blue chips. And that reputation is exactly what kept people holding. They could not believe that a company this iconic could truly be in decline. Third, Kodak. Eastman Kodak dominated photography for over a century. The stock traded above $80 in 1997. Here is the cruel irony. Kodak actually invented the digital camera in 1975. But they buried it because they were afraid it would cannibalize their film business. Investors who believed in Kodak's brand held on as the stock dropped from 80 to 60, to 40, to 20, to 5. In January 2012, Kodak filed for bankruptcy. Shares became worthless. In each case, the story was the same. Investors had a reasonable thesis when they first bought. But when the thesis broke, they could not let go. The sunk cost of their original investment anchored them to a position that was bleeding value every single day. So how do you protect yourself? Here are 3 practical rules. Rule number 1. Ask the replacement question. Every time you review a losing position, ask yourself this: if I had cash instead of this stock, would I buy it today at this price? If the answer is no, you should sell. The money already lost is gone. The only thing that matters is what your remaining capital can do from this point forward. Rule number 2. Set a pre-commitment sell discipline. Before you ever buy a stock, write down the conditions that would make you sell. Maybe it is a 25% decline. Maybe it is a change in the company's competitive position. Maybe it is missing earnings 3 quarters in a row. Whatever it is, write it down when you are calm and rational, and then follow through when those conditions are met. Rule number 3. Reframe the loss. Instead of thinking about what you have lost, think about the opportunity cost of holding. Every dollar trapped in a losing position is a dollar that is not working for you somewhere else. If your stock is down 40% and has no clear catalyst for recovery, that remaining capital could be earning returns in an index fund or a better opportunity. Holding a loser is not free. It costs you the returns you could be earning elsewhere. Here is the principle I want you to remember. The money you have already lost in a stock is gone. It is not coming back just because you keep holding. Your only job as an investor is to put your remaining capital where it has the best chance of growing. Warren Buffett has said, the most important thing to do when you find yourself in a hole is to stop digging. The sunk cost trap convinces you that holding is safe. But holding a broken investment is not being patient. It is being stubborn. And in investing, stubbornness is expensive. If this video helped you understand why letting go of losers is so hard, hit that subscribe button. Every day on this channel, we break down the real principles behind successful investing. No hype, no get-rich-quick promises, just proven wisdom that has built wealth for decades. Tomorrow, we are looking at a pivotal moment in market history that changed investing forever. You do not want to miss it. I will see you then.